Welcome back to Notes Edition. I've got another idea on my phone here. Today's note is called, "Why is inflation considered necessary?" One argument supporting the need for inflation is its ability to stimulate the economy. If there's a lack of economic activity, a lack of jobs, the central bank swoops in to help by adjusting interest rates or otherwise printing stimulus. The idea is that with a hard monetary system like the gold standard, if the rate of population increase or new demand for currency outpaces the supply of that currency, people will naturally be incentivized to hoard wealth instead of spending it to stimulate the economy. While deflation often slows down trade, deflation alone doesn't stop people from working to build their own wealth. Given lean enough conditions, people throughout history would round up the community to improve their situation back when you could chop down a tree and build your own house. Politically affiliated economists see inflation as a necessary tool to stave off deflation, but what about deflationary conditions caused by taxes? Say there's $1 million of money supply. Every time that money moves, it stimulates a part of the economy to act, providing a service to the buyer accompanied by a taxable event, such as sales tax. When that tax money trickles up, it essentially reduces the money supply of the community, making it feel like there's less and less opportunity, unless, of course, the government decides to spend some of it. Yet, if the government reacts to this contraction of the money supply by printing new money, instead of recirculating its treasury of previous tax collections, it retains its power while pretending to restore balance to the economy with inflationary measures via government services. This chronic practice of deficit spending siphons energy out of the system while people slip into poverty, desperate enough to keep working to make up for that economic contraction. The banking class is disincentivized to allow communities to evolve into self-sustainable microcosms. After all, if the lower class was comfortable enough, who would do all the dirty work for the upper class? If enough people were financially independent in their own community, who would be there to build the bank its next skyscraper? Inflation keeps people hooked working for paper. Meanwhile, those closest to the money printer can leverage the cash flow made from lending to buy up assets like stocks and real estate, further compounding their wealth. From the Keynesian perspective, where institutions decide what money is, inflation helps keep the economy moving. The devaluation of the currency ensures that people spend it back into the economy more quickly, as holding on to a weakening currency reduces the benefit of saving. From the Austrian perspective, where the market decides what money is, capital is saved or spent based on time preference and opportunity cost. I won't sell my house this year if I'm confident I can get double the price next year. The benefit of the Keynesian model is that central planners have a high level of control over people and are able to get more productivity out of the working class. The benefit to the Austrian model is that the individual is empowered through the ability to store savings that preserve purchasing power, contributing to the marketplace more authentically and sustainably. While the inflation of anything of value is natural, inevitable, even necessary at times, inflation of currency by government decree puts power in the pockets of the people closest to the printer. And that's today's note.